Thank you, Mr. Chairman. And first of all, I want to mention that I really like this proposal versus 2026. I think it increases both transparency and clarity. And so I'd like to ask a couple questions. I'll start with Mr. DeGengi. In 2023 rule treated regional banks like Wall Street giants. How does the 2026 fix better tailor requirements to risk size and business model in managing that risk?
So I think the 2026 proposals basically recognize that there is a congressional mandate to tailor requirements. That is a mandate. It's not an option. And therefore, the enhanced risk-based requirement, the new standardized requirement, applies to the largest banks, the Category 1 and Category 2 institutions. And then they've proposed a revised standardized approach, which is new, which the 2023 rules did not have. But the revised standardized approach is meant to apply to smaller banks. But at the same time, to the extent that a regional bank does a side-by-side comparison and decides that there actually would be some benefit to adopting the more enhanced, more risk-sensitive approach, they have the option to do so. So it really gives banks an option to decide what level of complexity of capital requirements they want to be subject to.
Thank you. And Mr. Baer, how does this proposal keep Dodd-Frank capital floors in place while making smarter changes above them to unlock potential growth?
Right, and I just follow up with the regional banks just to add, because it hasn't really come up today because it isn't technically part of the hearing. But I think for regional banks, they are going to have good options with regard to capital, and they won't be discriminated against vis-a-vis the largest banks. But a lot of the burdens are actually supervision, the burden of examination on them when they are not systemically important. And I think that's where a lot of the agency actions around defining safety and soundness, material risks, things like that, I think are going to be really important for regionals. It's also why, as I noted a few minutes ago, why tailoring is going to be really important. It is the case. I mean, this proposal, although some try to lampoon it as something else, is very consistent with the Basel approach. In fact, it cues more closely to Basel than the 2023 proposal did. And so, it's very much in the mainstream of what was intended by Dodd-Frank and the Basel Committee. And it really sets the U.S. up, again, with a predictable, sensible, risk-sensitive approach, whether you're a GSIB, a regional bank. And again, the smallest banks have the option of just simply doing a leverage ratio because their balance sheets are not terribly complex, and they've received relief on that. So I do think, regardless of where you are on the complexity spectrum, you're going to see some sensible capital relief here that will incentivize you to make smart loans.
Well, I think in general, Mr. Chairman, I think the focus needs to be on that certainty and stability that you're trying to offer banks, given flexibility that fits their model best, because the goal is to make access to capital less expensive. And when the banks are given that option, I think they're going to meet those customer needs. The last question I'll ask Mr. Baer, and if others want to pipe in as well, would be great. I think the 2023 issue lacked clarity. As I mentioned before, how does this new proposal actually increase transparency as well? I think that's one of the things that people want to see from the banking industry is that transparency. It's one of the things I've been pushing for in budget matters. But how does this issue on really elevate the transparency angle versus 2023?
Right. So, I mean, I think when it comes to Basel and the GSIB surcharge, it's status quo. I mean, the big change has been on the Federal Reserve stress test, where the scenarios were never put out for comment, and where the models were secret. The Fed, I think, has done an exemplary job. It took a lot of work, but they have now published both a scenario design guide. They will be publishing scenarios every year for public comment, not just bank public comment, but anybody's public comment, academics, and then the models are now public as well. I think as a result of their being public and being subject to comment, they are going to get much more accurate and much better. Again, the remaining changes, particularly around market risk, where the models are fantastically complicated, it will be a matter of reconciling those with what's in the standardized approach for market risk in the Basel proposal. But again, it is an underrated virtue of this set of proposals that the U.S., and I would say in quite significant contrast to Europe, is going to be a place where people who invest in banks know what the rules are going to be, whereas I think European banks lumber under a series of sort of secret capital charges that they call Pillar 2.
And I would just say, Mr. Chairman, I think this is one of the keys, is to take the mystery out of banking, and there's no better way than to have this type of clarity and transparency to take some of that mystery away. And with that, Mr. Chairman, I yield back.